Hello, everybody. Welcome to this webinar brought to you by Kenanga Investment Bank in collaboration with Rakuten and Bursa Malaysia. Today, our webinar title is Kenanga Oil and Gas Sector Outlook. Where do we go from here? So my name is Shen Chu. I'm the moderator for this webinar. Now, oil prices have seen some volatility recently. Now, ever since breaking above $100 barrel mark last year, oil prices have been steadily trading at a downtrend, with it currently trading at around $70 to $80 per barrel. So does that mean that the outlook for this sector has vastly deteriorated? What is the long-term outlook for this oil and gas sector? How will this impact our locally listed oil and gas companies? So in this session, we're going to take a deep dive into this fundamental of the oil market, as well as its impact towards the listed oil and gas counters within the industry. So by the end of this session, we hope that you'll be able to gain a better understanding of this oil and gas sector and be better prepared for the trading opportunities or investment opportunity that this sector reveal to you. So before we begin, as usual, our disclaimer: whatever we share in this session is only for educational purpose. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. So allow me to introduce our speaker today, and he's none other than Mr. Stephen Chan, who is the Senior Equity Analyst of Kenanga Investment Bank. So Stephen, good to have you here today with us today.
Hello, hi everyone. Hi, thank you, Shane, for having me here. It is a pleasure. And thank you, Kenanga, thank you, Rakuten, for organizing this.
All right, cool. So I will hand over the session to you.
All right, thank you very much, Shane. Give me a couple of seconds to share my slide. All right. I hope everyone can see my slide. I'll put it on full screen. Just give me a second. All right, I hope everyone can see my slide.
Yes.
Good. All right, so the oil and gas sector, where do we go from here? I think just a general introduction of the oil and gas sector. It is not a very simple sector. I do admit. Sometimes, things can be quite complicated because there are many factors involved in determining what direction does oil prices tend to trade towards, and also that not all of the companies that are listed in Bursa Malaysia are directly impacted to oil prices as well. So sometimes you might wonder how come oil prices move up, but not the share that I bought doesn't move up, or sometimes it even goes down. So it is quite it is sometimes a complicated sector, and I hope that towards the end of the session, everyone here can have a better understanding of how the sector works, as well as our current position in the sector and what is the outlook going forward. Hence the title, where do we go from here, right? Just a brief introduction. What of the contents that we are going to go through today. Firstly, we will start with the history and overview of crude oil prices, for the last 10 years, last 10 to 15 years, how oil prices have been trading, the ups and down cycle of oil prices. Next, we'll take a look at the oil price outlook going forward, what we think oil prices will trade towards. We will look at the long-term relevancy of oil and gas. As you all know, renewable energy is starting to come up. EVs are starting to come up. There are some arguments that in the long-term future, that there is little use or little relevance to oil and gas. So we will explore that as well. We will go through on an introduction to the locally listed oil and gas players. We will go through the sector overview and the outlook, and I think we'll wrap up with the stock picks and conclusion, and followed by the Q&A. All right. So this chart shows the history of oil prices since 2010 until the present day, right? If you look at the early 2010s, oil prices were actually trading for a good few years, it's above $100, $100 to $120 per barrel, right? That one was basically a bull cycle for oil prices over the over this period of time. What happened in about 2014, 2015? Oil prices actually took a sharp dive down. First dive down was about 50. The second dive down was about all the way down to 30. The main reason of this dive was because there was an oil glut, meaning to say that there is an oversupply of oil during this time. Right, oil production suddenly shot up because of technological advancement. There's the emergence of shale oil, especially from the US, because of, as I mentioned, technology advancement. The break-even price of shale oils has drastically reduced, which triggered a lot of new introduction of supply into the market. Right, towards this period of time, around early 2016, OPEC, which is a coalition of the major oil-producing countries in the world, started to what I think we should put a buffer towards this downtrending oil prices. They came together, and it is then where they start to limit the production of oil, right? So there is a control of the production of oil, right? OPEC, the coalition, started to limit production. That gave some support to oil prices, which managed to see a recovery for the next few years. The next shock in oil prices came from 2019, 2020. I think this is, as you all know, are very, very familiar. This was triggered mainly by the COVID-19 pandemic. And just weeks before the COVID-19 pandemic, there was also a Saudi-Russian price war, where both of them, which are members of the OPEC Plus coalition, could not agree to a production level. So they for a brief period of time they did not see eye to eye. So hence they went into a price war. Full basically, I produce as much as you can, you produce as much as you can, and try to flood the market. And a few weeks after the price war, the COVID-19 came, which further exacerbated the situation. So oil prices, expectedly took a deep dive, almost to $20 per barrel, as you can see here. It is at the bottom where OPEC once again agrees to extend the production cuts, right? So they all get together. I think we should put a stop to this, and they put a cap to their production as well. So oil prices started to rally since then, right? The big trigger of the rally, as you can see here, happened in the early of 2022. It is when Russia decided to do the full-scale invasion of Ukraine, and that actually caused a lot of supply constraints to the market, right? Especially as the Western countries decided to impose trade sanctions, embargoes on Russian oil export, right? That actually for a period of time, removed a lot of the oil supply in the market, which caused this rally to surge throughout 2020. And of course, I think as per the introduction that Shane has given, after peaking at $120 per barrel, oil prices actually is trading at the decline until today, the present day. If you look at a chart for 2022, so this is just a 12-month chart throughout 2022. There is a lot of factors, I understand, towards what is contributing to the downtrend of oil prices. But I think the main point that you should look at is, of course, early of the year, that there was a resurgence of Chinese lockdown, right? In March 14, you can see here. So the Chinese lockdown, I think, gave a bit of fears towards the demand growth of oil in 2020. Apart from that, apart from the lockdowns in China, there was also a lot of recessionary fears that's going on in 2022. You can see, right? There is a lot of, like in June 15, US Fed had a rate hike, Bank of England had a rate hike. So all this is to tackle the the inflationary fears, the recessionary fears, and it's also in the best interest of the US to try to bring down oil prices as much as they can, because they're trying to tackle inflation. And unfortunately, oil prices is one of the major contributors to inflation, right? Now, if you look at this chart basically explains the first oil glut that we have seen here, right? This one, in early 2014, 2015, where I mentioned that there is an emergence of shale oil. If you take a look at that time, this is the break-even price of oil. The average US shale oil break-even price is represented by this red line. As you can see, in 2013, right, break-even price for US shale was $70 per barrel. And because of technological advancement, oil prices did not need to trade so high in order to break even. So it gradually came down. By the end of 2016 and towards 2017, break-even price for US shale has actually came down all the way to almost $30 to $40 per barrel, which introduced a lot of new supply to the market, which then again explains this steep decrease in oil prices back then in 2014, 2015, right? If you look at the production numbers of US crude oil, which is mainly shale, you look at the mid-2010s, there is a sudden surge in production numbers, right? Look, there is a sudden steep climb in this graph. And again, this is because of the lower break-even price of US shale due to technological advancements. If you take a look at the breakdown of global oil production, right? But as a country, US is actually the largest oil producer in the world, right? Currently, they produce at about 20% of oil in the world. OPEC, as I mentioned, is a coalition of several of the large oil-producing countries in the world, one of which is Saudi Arabia. And OPEC as a bloc produces 34%. So, but this is as a bloc, you see. So as a single country, the US is actually the largest producer of oil. Former Soviet Union, which includes Russia and all the other former Soviet Union countries, contributes about 14%. Russia alone contributes about 10 to 11%. So the other former Soviet Union countries contributes the other 3 or 4%, right? If you're wondering how much oil does Malaysia produce, Malaysia produces about 0.6 million barrels per day. That's basically less than 1% of the global oil supply. All right. If you take a look at the breakdown of OPEC production levels, right? As I mentioned, OPEC, the coalition of the few largest oil producing countries. I think there's no surprise. Saudi Arabia is the biggest oil producer, 10 million barrels per day. Everyone else is very small, right? Iraq is about 4 million barrels per day. Kuwait is next, about 3 million barrels per day. UAE is about 3 million barrels per day. The rest is very small. So you can see that the 10 members of OPEC, the biggest player is Saudi Arabia, right? If you take a look at these numbers here, right? If you can remember the previous chart that I've shown you, OPEC has consistently been capping their own production, right? Has always been announcing production cuts. And that is what supported the oil market throughout the last few years. But over the recent few years, right, over the recent 2 or 3 years, because of underinvestments in the industry by these oil producing countries due to COVID, because COVID, basically everything is locked down, they couldn't perform their normal investment activities. So there is a huge underinvestment in the oil and gas market during the COVID years, which has led a lot of these OPEC countries to be unable to ramp up their production on call, right? As a result of that, their target output, right? If you look at this number, the target output is actually higher than their actual output. In other words, their compliance ratio to their own production cut is more than 100%, right? Because they have pledged to cut a certain number of barrels of oil, but the actual production numbers actually they have cut even further because they have not even met their own production target, right? So this is an unusual case because pre-COVID, compliance cut numbers are usually below 100%. Usually it is very difficult to get everyone to follow the rules. So, but because post-COVID, during the COVID years, because of the underinvestments, a lot of these OPEC countries were not able to ramp up productions on call. If you take a look at this graph here during the COVID years, the red line is basically their production quota. And you look at the blue line, the actual production numbers has always been under their production quota, and hence their compliance ratio, right? The compliance percentage has always been more than 100%, right? If you look at some months in 2022, the compliance percentage is actually even as high as 200%. That means they are cutting twice as much as they need to in terms of their production numbers. All right. Now, a breakdown of global oil consumption. I think it's no surprise that as a country, US and China are the two biggest oil consumers. US is about 20%, China is about 15%. Europe is also a big one, about 15%, and the rest is pretty spread out. If you take a look at the demand supply dynamics of crude oil, before COVID, the demand and supply of crude oil basically balances out at about 100 million barrels per day. When COVID happened during 2020, the demand and supply actually dropped, right, to almost 90 million barrels per day. Since then, demand and both demand and supply has gradually recovered, and now the demand level has actually more or less recovered back to pre-pandemic levels already, almost at around 100 million barrels per day. Now, if you take a look at this forecast, the blue line is the production number. The brown line is consumption number. You can see that the forecast is that throughout 2023 and 2024, there is actually a slight overproduction, right? There is a slight oversupply. Production is more than consumption, which leads to implied stock build. Implied stock build is meaning to say the production minus the consumption numbers, and you can see it's a positive. So meaning that there is a stock build instead of a stock draw, which is one of the reasons on why oil prices have been downtrending ever since peaking above 100 last year as well. This is one of the main reasons as well. It's because is because supply is expected to outpace demand over the next 1 or 2 years, right? Based on this forecasted data, right? If you take a look at OPEC production levels, right, during the COVID years, obviously it dropped a lot because this was also part of their announcement of production cuts, and since then it has been gradually on the rise. All right. Now, just to summarize all the points that we have went through, as I mentioned, we are expecting oil prices to be weaker this year versus last year. This year, oil prices actually we are expecting Brent crude oil prices to average at around $80 per barrel, right? Last year, Brent crude averaged at around $99 per barrel. As I mentioned, the current supply is slightly outstripping demand, and stock building levels is a record high in 18 months, right? Much of the supply overhang basically comes from Russia, right? As Russia reroutes a lot of its oil exports away from EU to the Asian markets, right? The Russian oil production numbers has actually reached pre-war levels, right? So has gradually improved to reach pre-war levels. India and China are their main buyers for Russian oil, and these two countries alone contributes about 70% of Russia's crude oil export last month. So you can see in the numbers. Number one, Russian oil basically has seen a resurgence into the market, right? Oil production from Russia has already reached back to pre-war levels. Number two is that India and China contributed to 70% of Russia's crude oil exports. So meaning to say that despite the reopening of China, the growth in demand in some of the economies in India and in China, it looks like Russian oil, which was previously sanctioned by the EU, previously sanctioned by the Western allies, now has actually found a way back to the market, back to the Asian market, right? Which also one of the reasons why it contributed to the slight oversupply that we are seeing currently, right? As I mentioned, world oil supply should still comfortably exceed demand in the first half of 2023. There is expected improvements in the second half of the year, driven by the rebounding air traffic and the release of pent-up Chinese demand. All right. Now, if you have been following the news, OPEC last week has actually announced its decision to cut output by 1.16 million barrels per day, which we take as a positive surprise because OPEC earlier in the year actually they have guided that they were not looking to increase their output cuts throughout the rest of the year. So them suddenly deciding to announce a 1.16 million barrels per day production cut is a positive surprise. But bear in mind, the point that we mentioned just now, that OPEC's compliance to its production cuts has been consistently been above 100% over the past 2-3 years, right? So they have always been underproducing what their target was, and hence the actual production number may not be reduced as much as advertised, right? So if you look at the on the ground month-on-month changes in OPEC's oil production number, it might not change 1.1 million barrels, right? It might actually even stay flat or even see a slight increase because they have been consistently underproducing their target. So now you bringing the target down does not necessarily mean the actual production number has increased. What this means more is that they are essentially capping their future production numbers so that they are lowering the bar so that in the future they cannot produce as much as they initially wanted. Over the long term, right? Over the long term, we are looking at Brent crude oil prices to normalize back to $60 to $70 per barrel, which we feel is a sweet spot, a sweet equilibrium for both the producers and the consumers, and as well as the contractors, right? So in summary, right, this year we're looking at an average of $80 per barrel versus last year about 100. Long term, we are looking at about $60 to $70 per barrel. We believe that oil prices would tend to normalize at this range, right? Too low, it'll be very unhealthy because the oil producers will be losing money. Too high, it will also be unhealthy because you will lead to expensive oil prices, expensive pump prices, inflation and this and that. So it will be bad for consumers as well. So all in all, we feel that $60 to $70 is the sweet spot in which the market will tend to normalize back over the long period, over the long term. All right. Now, is oil and gas still relevant? I think when we explore the oil and gas sector, this is a question we must first ask, right? Given the rise of renewable energy, given the rise of EV, some might wonder, is oil and gas still relevant in the longer term? Well, if you take a look at this forecast as provided by the EIA, it looks like petroleum and natural gas, i.e. oil and gas, will remain the most consumed source of energy throughout 2050, although renewable energy is the fastest growing, right? Let's take a look at this graph. This green line is oil, petroleum. The blue line is natural gas, so gas. So oil and gas is this blue line and green line. Even by 2050, right, it will still be the most consumed source of energy, right? This green line here, which is renewable energy, you can see it is the fastest growing, that there is still there is a sharp increase, right, throughout the next 20, 30 years. But even by 2050, oil and gas will still be the most consumed source of energy, right? If you take a look at the uses of oil, right, the uses of petroleum, transportation is number one, right, followed by industrial, commercial, residential, and electric power. But transportation and industrial are the main uses of oil from now until 2050. And when transportation, basically cars, if you look at this forecasted data, right, this blue, dark blue color here refers to gasoline cars, right? So even by 2050, most of the cars will still be gasoline powered, according to this forecast. Battery electric, hybrid, plug-in hybrid electric cars, which is this green, light green color and this blue color, as well as electric hybrid, this red color here, will be growing exponentially, right? Will be growing exponentially. You look at pre-2020, their market share is almost non-existent. By 2050, there'll be quite substantial market share that is going to electric hybrids, plug-in hybrids, battery electric. But by far and large, most of the cars by 2050 will still be powered by gasoline. If you take a look at this data, because of the rise of EVs, because of the rise of plug-in hybrids, the average fuel economy of vehicles, light-duty vehicles, i.e. your cars, will see a steep increase, right? So cars in the future will get more and more efficient, right? You look at this black line, the reference points, right? So the average fuel economy, the efficiency of cars will get higher and higher. The market share of electric vehicles will see an exponential growth, right? By 2050, according to the reference point, is about slightly less than 20% of market share. But then again, far and large, most of the cars will still be gasoline powered. Now, if you take a look at gas, so previously we were talking about oil. Now we're taking a look at gas. Gas, the biggest use of gas is for power, right? Power stations, this light green here. Manufacturing, buildings, transport, all these are the main uses of gas. And if you take a look at this forecasted data all the way to 2050, even by 2050, right, the uses of gas will still be there for power, for manufacturing, for buildings. If you take a look at Malaysia ourselves, right, locally in Malaysia, what is the power capacity mix? This is by the Energy Commission of Malaysia. 2021, 17% of Peninsular Malaysia's power capacity came from RE, renewable energy, right? Obviously, over the years, it's expected to increase drastically. By 2039, RE's market share of power capacity mix is expected to reach about 30 or so percent. But you look at this blue one, this blue bar here, right? Gas. So gas will still remain relevant throughout the next 20 to 30 years, right? Throughout the next 20 years, gas will still be relevant. Coal, on the other hand, will see a stark reduce over the years, right? Because coal, as you all know, is very, very, despite it being cheap, is very, very bad for the environment. So you can see, yes, RE is the fastest growing, but gas will still remain relevant for power consumption, power generation in the long term as well. So I think these few slides hopefully has answered some of the doubts. I think it is safe to say that at least over the next 20 to 30 years, there is still a very strong relevance for the usage of oil and gas, right? Now, an introduction to the oil and gas value chain. When we take a look at oil and gas companies, right, they are generally categorized in three segments. We call it the upstream segment, the midstream segment, and the downstream segment. Upstream refers to basically your oil producers, something like your Petronas, Carigali, the companies that are actually doing the exploration, doing the production, actually going out to the sea to drill oil and produce and extract the oil from the ground, right? These are what we call upstream companies. Midstream refers to companies that are involved with the process and storage, as well as the transportation of oil. So your piping companies, your storage companies, your shipping companies falls under midstream. Downstream refers to the value chain whereby you process the oil, you refine and you process the oil, and you take the oil to end users, i.e. us, right? Laymen such as me and you. So your refineries are downstream players. Your distributing and marketing and retail are downstream players, i.e. your petrol stations. These are downstream players. All right. So upstream, midstream, downstream. I hope this is a clear picture on how we segregate the oil and gas segment via its different value chains. Right. Now, we take a look at the Bursa Malaysia companies, right? The listed companies, the PLCs, the public listed companies. So what is in upstream, what is midstream, and what is in downstream, right? So I put it neatly over here. In upstream, we have several companies. Fabricators refer to companies which are basically construction companies. They are the companies that construct your offshore structures that are used in your oil fields, right? So fabricators include Sapura Energy, which currently is still undergoing PN17, MMHE, right? Malaysia Marine Heavy Engineering, right? Exploration and production. This includes the likes of Hibiscus. So what they do, as the name suggests, they go out, they explore for oil, and if they found any oil, they they will produce the oil. So basically, they are owners of the oil field, right? They are the owners of the oil field, right? And in this example, we have Hibiscus. Well services providers, right? So they are the ones in which the oil field would employ to help and enhance their production, right? To do well services and to enhance their production. Here we have USMA, we have Delium, we have T7, we have Reservoir Link. Drilling rig providers, right? Valesto and Sapura. So Valesto is actually the biggest drilling rig player in Malaysia. I think is the one and only jackup drilling rig provider in Malaysia, right? That is locally listed. OSVs. OSV stands for offshore support vessels, and in OSVs we have Alarm, Perdana, Icon, Coastal, some of the OSV players. Pipe players. So Hwaseong, what they do is they do pipe coating. Pentec, they do pipe manufacturing, pipe fabrication, pipe trading. So sometimes, you know, when you're developing a new oil field, you need to lay underwater pipes to transport, you know, the oil from your oil field to onshore. So these are what these companies do. FPSO, right? FPSOs are basically it stands for floating production storage offloading. Basically, they are huge infrastructures. You know, it's huge. You know, usually the price to develop one FPSO is in the hundreds of millions. They are infrastructures that are fixed in the oil field that will help do the processing, the storage of the oil, right? So not all oil fields use FPSOs, but FPSOs are a huge infrastructure. Just remember that. Okay, and in FPSOs we have Yinson, we have Bumi Armada, we have MISC. Right. For midstream companies, we have oil storage, which is Dialog. If you all know, Dialog has operations in Pengerang, where they operate a lot of these huge storage tankers in which you know, a lot of their clients used to engage their service and store oil in these tankers. Shipping providers, you have MISC. So MISC is basically one Petronas subsidiary that provides shipping services for the oil and gas sector. In downstream, we have the maintenance, the topside maintenance guys. So Dayang, Charmin, these, what they do is they do maintenance for the offshore structures, right? The offshore structures, which are at sea. So these guys are basically your repairmen if anything goes wrong for in the offshore structure. Onshore, right? Onshore on the land, your maintenance providers, you have Serba Dynamic, you have Dialog. Petrochemical players, you have Petronas Chemicals, PChem here, LC Titan, Lotte Chemical. Distributing and marketing, we have PetDeck. So PetDeck essentially operates all of the Petronas petrol stations that we see on the road. So that is actually under PetDeck. All right. Refineries, we have Hengyuan and Petron. All right. Another way to look at the locally listed oil and gas players is by this graph, right? You can see that Petronas is the regulator, the big brother of the oil and gas industry in Malaysia, right? Now, just under Petronas are your operators. Basically, as I mentioned, your exploration and production companies, right? These are the companies that are actually owners of the oil field, right? And below them are your contractors, your subcontractors, your specialists, your consultants, your vendors, your agents. All these here are what we call OGSE, which stands for Oil and Gas Service and Equipment Providers, right? OGSE, Oil and Gas Services and Equipments. You can see a lot of familiar names here, right? Like USMA, MMHE, Bumi Armada, MMC, MISC, Destiny, Icon, Moiba. All these are like Yinson as well. Charmin, Velesto. So all these are locally listed players, right? And as you can see from this graph here, you tend to realize that most of our locally listed oil and gas players falls under this category, right? The OGSE category, the contractors category, right? Some, like I mentioned, Hibiscus, and to a smaller extent, Dialog, they fall under this category, whereby they are operators, they're owners of the oil field. But by and large, most of the companies that we see in Bursa Malaysia are actually contractors, right? That falls into the OGSE space down here. All right. Now, we take a look at the outlook of the local oil and gas sector. As I mentioned in this slide, Petronas is the regulator and the largest operator, right? Petronas here, the regulator and largest operator of the oil and gas production in Malaysia. So every time when we take a look at how the sector is going to perform over the next few years, we always tend to refer to what Petronas is going to do. When Petronas increases its capex, basically that translates to more activity levels, more jobs for your contractors. And as you recall, most of the listed players are contractor names that falls within this category. So when Petronas increase capex, essentially there's more job for contractors. When Petronas reduce capex, there's lesser jobs for contractors. Take a look at the capex trend of Petronas over the last few years, right? If you can recall the very first slide that I've shown you guys, pre-2015, where oil price is in a boom, capex level was at a high. Since then, when the oil price crashed, right, the capex levels have slowly deteriorated. Until 2022 onwards, we see a new uptrend in the capex cycle, right? And over the next 5 years, Petronas is guiding 300 billion ringgit capex, which averages out to about 60 billion ringgit a year, right? 300 divided by 5, 60 billion ringgit a year. So 60 billion ringgit a year on average for the next 5 years. How does it compare to the yesteryears? How does it compare to all the years previously? This is basically the highest we have seen since the previous oil boom, right? Since the highest has been since pre-2015. So ever since 2015, we have actually not seen capex spending at such a level. At an average of 60 billion ringgit a year, it's actually almost doubled from what we see from the COVID years, 2020, 2021. Petronas capex is only about 30 or so billion, right? That means to say in the local market for the next 5 years, there will be a lot of jobs, a lot of opportunities for the contractor names. And as I mentioned here, 80% of this capex figure will be in hydrocarbons, will be in oil and gas. All right. Now, this is the breakdown of Petronas capex last year in 2022. In last year, 75% of Petronas capex was actually in its core business of basically hydrocarbons, oil and gas. 25% is in energy transition and decarbonization. So basically your green energy, new energy is 25% of the capex. 75% of the capex is still in oil and gas. And as I mentioned in the previous slide, over the next 5 years, it is expected to be 80% in oil and gas, right? Upstream is still the biggest area of investment from Petronas, followed by downstream, the second largest. Gas and C&Os basically is your corporate and operations. So you can see that upstream actually it is still the largest area of investment for Petronas last year, and we believe that this is the trend to stick going forward for the next 5 years as well. Right, if you take a look at Petronas annual dividends. Now, why we look at Petronas dividends, right? Petronas is a wholly owned company by the federal government of Malaysia, So all its dividends go to our federal budget. The reason why we look at Petronas dividends is because the lower dividends that Petronas pays, right? Theoretically, it means that it is less obstacle for them to meet their capex guidance, if that makes sense to you, right? So in 2023, they have actually declared lower dividends to the federal government, 40 billion, versus what they paid in 2022 last year, which is 50 billion. So dividends to Petronas, from Petronas to the federal government is lower. Their net cash position at 108, sorry, it's a typo here, is 108 billion ringgit, the highest it has ever been since 2018. So that means to say that Petronas dividends are lower, their cash pile is stronger, the profits are stronger compared to the pandemic years, right? We see very little reasons, very little obstacles for Petronas to not meet its own guidance of 300 billion capex for the next 5 years, or 60 billion ringgit a year, right? There's very little reasons for them to not meet, because they have strong cash position, they have lower dividend commitments to the government, right? Now, previously we have always been talking about Petronas. What about globally, right? Globally, you take a look at this black line here. This black line represents the offshore E&P. E&P stands for exploration and production. Offshore E&P capex, right, is also expected to be on a steep uptrend, right? And even in 2023, 2022, 2024, is expected to well surpass, you know, the COVID years, and even some of the pre-pandemic years as well. So I think in summary, it is safe to say that both locally and globally, we are seeing an upcycle in capex spending, right? Both from Petronas as well as from the global players. If you look at Petronas activity outlook, what they are guiding, the activity outlook will look like in the next 3 or so years. You can see that almost all the graphs you can see here is actually all uptrending, right? Drilling rigs, as you can recall, drilling rigs are Valesto is the biggest operator of drilling rigs in Malaysia, right? 2023, 2024, 2025 compared to 2021, 2022 is expected to be strong. Offshore fabrication, again, you see the number of jobs. 2023, 2024 is expected to be strong. HUC stands for hookup and commissioning. MCM stands for maintenance, construction, and modification. The MCM and HUC space is basically players like the offshore maintenance players that I mentioned, such as Dayang, such as Charimin. So they operate in the HUC MCM space. And as you can see as well, compared to the 2021, 2022 levels, 2023, 2024, 2025, next 3 years, expected to see an increase as well, right? Offshore support vessels, again, 2022, 2023 is a lot stronger than 2020, 2021. Decommissioning. So who does decommissioning? Decommissioning. One of the companies that provides decommissioning services is USMA. You can see the number of wells decommissioning is also expected to be on the rise in 2024, 2025, right? Compared to 2023 levels. 2021, 2022, you can see an overall trend. So I think safe to say that almost a huge majority of the activities that Petronas is guiding will see an uptrend over the next 3 years, right? So in summary, right? In summary, we are having a neutral stance on the sector. Neutral stance because we do not see much catalyst for the big cap names, right? Big cap names, basically your Petronas related counters, your PChem, your PEPDAC, we don't see that much catalyst in that, right? The catalyst, and I believe the focus should be placed on the contractor names, the ones that can benefit from the upcycle in capex. So because the sector is we evaluate the sector based on a market cap weightage, right? There is very little catalyst for the big caps, so we have a neutral stance on the sector, but you can focus on the smaller cap names, the contractor names that can benefit from the uptrending capex cycle. Again, the point that I've mentioned earlier, we're expecting weaker oil prices, right? In 2023 versus 2022. But again, despite the weaker oil prices, we do not think this will deter capex spending. And in fact, capex spending will actually increase over the next few years, right? Activity levels are expected to be strong, right? Again, Petronas is expected to spend 300 billion capex over the next 5 years, 60 billion ringgit average per year. And we see little difficulties in Petronas meeting these targets, given its strong cash position and its lower dividend commitments, right? And globally, the same story as well, right? Global offshore E&P capex is expected to be on an uptrend, right? Surpassing pre-pandemic years. So, after the summary of the entire oil and gas sector, what are our stock picks, right? What are our stock picks? For this quarter, what we have been promoting is Bumi Armada and Hua Xiong. We purposefully picked these two picks amongst all the other contractor names. As I mentioned, we should focus on contractor names because there is little catalyst for the big cap, especially Petronas related stocks. So amongst the smaller cap contractor names, we purposefully picked these two names because we feel that these two names have a higher certainty in terms of their outlook, right? Bumi Armada, over the last few years, right, it's basically it's basically a redemption story for the company, right? In years ago, Bumi Armada is actually known for its struggling balance sheet, its high borrowings, but over the last few years, it actually vastly improved. Their net gearing currently only sits at 0.9, right? And their borrowings level has actually fallen by 47% since 2018. Their operations have actually been much more stable. And because of the stable operations, the vastly improved balance sheet, they are now currently eyeing for new contract wins. They're eyeing for expansion. They're bidding in the global FPSO market right now. And we believe that it is an eventuality that they will secure a new contract in the coming few months, right? I think we are fairly certain that they are going to secure a new contract in the next few months, and that will act as a catalyst for the stock. Now, Bumi Hua Xiong. Hua Xiong, as you can recall, what they do is they do pipe coating globally. They are effectively operating in a duopoly market. So globally, there is only two players that can do the type of pipe coatings that Hua Xiong do, which is Hua Xiong, and another one which is a Canadian listed player, Shawcor. So Hua Xiong stands to benefit from the increase in global greenfield capex, right? So the global rise in capex will definitely benefit Hua Xiong because, as you know, the new pipe business will mainly come from greenfield investments, right? Its order book is at 3 billion ringgit, which is the highest it has ever been since 2016. So the order book is strong. Order book strong, meaning to say that it is just a question of timing on when will this order book translate to strong profits in their P&L in the upcoming quarters, right? So apart from these two picks, other names that we like are Yinsen, Dialog, these are long-term resiliency plays, means these are more defensive names, right? Yinsen and Dialog, we believe that you can buy these names and hold long-term. You should not see too much of a risk. Uzma and Dayang are good recovery plays, right? Uzma, they do brownfield, they do brownfield works, well services locally. Dayang, as I mentioned, they do offshore maintenance, right? They are good recovery plays. Good proxies to oil prices include Hibiscus and Petronas Chemical, PChem. But then again, as I mentioned, we believe that oil prices are expected to be weaker this year versus last year. So we don't see much catalyst in some of the bigger cap names, especially Petronas counters, right? Right. With that, I end my presentation. Thank you very much. I'll pass it back to Shane.
All right, thank you so much, Stephen, for the very enlightening sessions, walking us through the oil and gas value chain, as well as what are the topics in this sector. So if you have any questions to ask our speaker, Stephen, today, please write your question in the Q&A box so we can manage it effectively. Don't write them in the chat box here. Write them in the Q&A box. So the first question I have on my panel is that, will Sapura Energy be successful in restructuring their debt? What do you think?
Yeah, it's a very good question. What I believe Sapura Energy needs to do is that they need a savior. Basically, they need an angel investor. I think their debt level is far too high to solve the problems organically. Right? Internally, I think it's a bit hard. They definitely need somebody to come and save them. Whether or not whether it's a foreign investor, whether it's you know, Petronas themselves or somebody, but they need they basically need an angel investor to come in to rescue them.
So without an angel investor, you don't see them being successful in restructuring their debt.
I see it very hard for them to manage to settle off their debts internally, organically.
All right. The next question is by Geng Heng. Will there be any impacts to crude oil price from the global banking crisis in America?
Well, the short answer is yes, because I think, you know, in this day and age, you know, globalization and everything, all of our economies are linked, right? If you see a global banking crisis, definitely it will impact demand to oil demand, which again would impact crude oil prices.
All right, understand. So the next question is by Thong. Among upstream, midstream, and downstream, which segment is having the highest operating profit?
Well, if you are looking at in terms of both profit margins and absolute number, especially in the local space, it will definitely be upstream, right? And bear in mind that Petronas themselves, Petronas Cari Gali, is one of the major upstream players in Malaysia, and Petronas Cari Gali actually is the largest contributor to Petronas profits. Basically their most profitable subsidiary under the Petronas group. So the answer is upstream.
But I think it all depends on the oil price, right? If the oil price is very low, then the upstream players may suffer from severe margin compression.
Correct. Because when you're in upstream, basically you are, whether or not you are the operator or you are the contractor. If you are the operator, if the oil prices are up, basically your selling price is up, your profits are up. Your oil price is down, your selling price is down. On the contractor, if the operators do not produce as much oil because the oil prices are very weak, you don't get as much jobs as well. So of course, the entire sector is dependent on how oil prices trend going forward.
I see. We know that petrol is oil and gas is sold in US dollar. So the question here is, what is your opinion on de-dollarization? I think it has become a hot topic nowadays.
Yeah, I say it's a very good question. In general, for whatever reason, a weaker US dollar, a stronger US dollar will lead to lower oil prices. So a weaker US dollar will lead to higher oil prices in general, because oil prices are mostly quoted in US dollars, right? So every time we see a strengthening in US dollars, usually it will coincide with lower oil prices, usually. Yeah.
So what's your opinion on de-dollarization? Do you think that US dollar will drop out from being the world reserve currency?
I have no opinion in this. I think this is
too big of a discussion.
beyond the current oil and gas sector.
Yeah.
But if that happens, right? If that happens, it really depends on whether or not the global economies still quote oil prices in US dollar. I think I mean if of course if US dollar is no longer relevant and we continue quoting oil prices in US dollar, definitely, $1 you can barely buy a lot of oil already, right?
Yeah.
Yeah.
So on your stock picks of Armada, Bumi Armada, so the question here is, what is the basis of the target price? Is it SOP based or is it PE based?
Yeah. Target price of Bumi Armada is SOP based. It implies a PE of about 5 or 6 times. It's SOP based.
Okay. So what is your outlook for the FPSO market in Southeast Asia?
I'll talk about globally first before I move on to Southeast Asia. Globally, the FPSO market is expected to be strong. There is a lot of job opportunities in Africa, in South America. Southeast Asia, there is some jobs as well. Indonesia, there is some jobs. Vietnam, there is some jobs. Malaysia, there is some jobs. But a lot of these jobs, right, even in Malaysia, right, they're a bit slow to be rolled out. I think, for instance, in Malaysia, we have this job called the Limbayong field, which has always been wanting to do an FPSO project for several years. But over the last few years, the project has been on and off a few times. So it is a bit slow. The jobs are there, but in the Southeast Asian market, it is a bit slow. I think the boom in the boom in the FPSO market right now is currently more focused in South America and Africa.
Thank you so much for sharing the idea about FPSO market. So at the current economic cycle, which segment within the upstream sectors offers better returns, and which segment should we avoid?
Yeah, I think this is a very good question. I think, as I mentioned in my presentation, right, we stay away from we are neutral on the big cap names, right? Big cap names, or the names that generally benefit from higher oil prices, like, for example, like Petronas Chemical. And if we think that oil prices are expected to stay muted, continue on a downtrend, eventually normalizing at a lower price at $60 per barrel, then we stay away from the operator names, the big cap names. We focus on the contractor names, which again I mentioned, is because the contractor names are the ones that can benefit from the capex upcycle, which we are expected to see over the next few years.
Thank you so much, Stephen. The next question is by Chris. Although we have a higher capex outlook from Petronas, the OSV space doesn't seem to have strong improvement in the next few years based on your chart. Why is that so?
Yeah, I think it's a very good question as well. OSV is quite a difficult segment to operate, because over the last few years, right, So the history is last time pre 2015, when oil prices were strong. Everybody wants to invest in OSVs because it's very, very profitable. What happened after 2015 when the oil price crashed? Suddenly there is an oversupply of OSVs, right? So the OSV market has always been in an oversupply over the last few years, even until today. The demand for OSVs have actually not been as high as what we have seen pre-2015. Charter rates are also not as high. So despite yes, improving activities, more or less the OSV actually is still at a slight oversupply, despite slowly improving from the COVID years.
All right, thank you so much, Stephen. The next question is on natural gas. Okay. So the natural gas price has tumbled over the past few months to its recent lowest level. Would you think that the oil price will be affected by this trend? And how is the relationship between the price of gas and oil in the past?
Yeah, it's a very good question. Yeah, oil and gas tends to trade in the same trend. Of course, the uses for oil and uses for gas is slightly different, but both are hydrocarbons. They tend to trade the same trend. So yes, natural gas is falling down from its high, but so are oil prices as well. And hence why we also feel that oil prices are expected to continue on the downtrend. At a longer term, will normalize back at the $60 per barrel mark.
All right, thank you, Stephen. So what is your view on this company, Delium?
I think what Delium does is they're one of the operator names, local centric operator names, a lot like Dayang, a lot like Usma. Definitely they'll be one of the beneficiaries of the increase in activity levels, similar with everyone else. If you see the history of Delium, there is a bit of concern of its governance, because previously they ran into some troubles with Petronas and corruption, but I think that has already been solved. So I think going forward, they will also still stand to benefit from the rise in activity levels locally, especially from well services, especially from the offshore maintenance MCM space as well.
All right. Thanks so much, Stephen. So the next question is, how would refineries like Heng Yuan and Petron do? What do they do?
So Heng Yuan and Petron refineries, in order to analyze the refineries, we look at something, what is called a crack spread, right? A crack spread basically is the price difference between the crude oil price versus the refined final product prices. And if you can see the crack spread trend, right, we're actually at a low. Although it's already bottomed up, we're actually at a low. So unfortunately, at these crack spread levels, it doesn't seem too favorable for us for the refinery names at the moment.
Thanks, Stephen, for the input. The analyst rating on Yinsen is very strong, and most IBs are bullish in Yinsen. Is it a good time to buy Yinsen now? So that's the question by Benedict.
Yeah. Yinsen is an analyst favorite stock, because they have very, very capable management. The management has been very transparent in terms of their guidance. If you look at their trajectory, right, they've always been winning contracts. They've always been very aggressive in their international bids. For a long-term hold, we have no problems with Yinsen actually. it is a very well-run company. We have no problems with Incent. The FPSO market is a boom, as I mentioned earlier, and hence why you know the last few months they also have won a new contract, and they're expected to win further contracts in the future as well. So we actually like Incent. We actually like Incent. So in our stock pick slide, we did mention Incent as a long-term resiliency play. The reason why we chose Armada as a top pick versus Incent, both also operating in the FPSO space, but the reason why we chose Armada, because Armada is more like the underdog name, you know. It is more like because Incent has always been very well run. Armada actually came from the bottom, right? They were suffering high debts in the previous few years. A lot of investors actually burned by this name, written off this stock, but now they're actually making a comeback. So we believe that the story is a bit more interesting at this moment in time compared to Incent. But Incent is always a good buy on long-term basis.
All right, thanks, Stephen. The next question is by Jing Yi. So the natural gas prices may be recovering soon. Is there any company that will directly benefit from this?
Yes. Basically, your operator names, such as Hibiscus, they are and also to a lesser extent, Petronas Chemicals, some of your petrochemical companies as well, PChem, Lotte. These are also the price trend of petrochemical products tends to mirror gas prices, or tends to mirror oil prices. So your operator names, your petrochemical names, these are the ones that can benefit from higher prices.
All right. What is your view on why oil companies are among the top 30 short sell stocks? That's the question by Ray.
It's a very good question. Top 30 short sell stocks. I think the reason why is the oil and gas sector is a heavily cyclical sector. Quarter to quarter earnings fluctuate a lot, depending on activity levels, depending on sometimes the weather, monsoon. It's very little predictivity in the oil and gas space. So it is basically ripe for speculation, right? And hence why oil and gas has always been a very volatile sector.
All right. The next question, comparing oil and gas versus technology, which is better in terms of growth and potential of higher investment returns? What is your view?
I think it's self-explanatory. Right, as I mentioned, oil and gas earnings trend for oil and gas tends to fluctuate on a year-on-year basis. If you look at the chart I've shown also previously, from a high to a low, from a high to a low, a lot of the tech companies locally listed in Malaysia actually have been very steady growth trend upwards over the last few years. Although these few years the tech sector is also facing some difficulties, but you take a bigger picture, long-term basis, you know, tech sector is still a growth sector. Oil and gas sector is a commodity, cyclical, fluctuating sector.
Thanks, Stephen. The next question is by Chris. Can Malaysia OSVs, jack-up rig player, go overseas, for example, Vietnam, or in the region to bid for projects? Do you think they can compete?
Yes, OSVs not so much. Jack-up rig player like Felesto, definitely yes. They are actually bidding for regional projects in Vietnam, in Indonesia. The problem, it's actually a good problem to have. The thing is, because the demand for jackup rigs in Malaysia now is very strong, there is no need for them to leave the country, right? Basically, Petronas' demand for jackup rig is much more than what Valesto and much more than what the market can supply at this moment. So if you look at the marketed supply of jackup rigs in the country, is actually 100%. Meaning to say that all of the rigs available have already contracts at hand. So at this moment in time, there is no need to go overseas, but they definitely can bid overseas for the jackup rigs.
All right. Thank you so much. So how do you view coastal? It is not so much in OSV now, but more on recurring income from South America.
Correct. Yeah. Coastal is a very interesting name because you look at their corporate history, right? They started out as a shipbuilder, then they slowly transitioned into an OSV player. Now, what they're doing is infrastructure project, gas processing infrastructure projects in Mexico. So transforming into like a job-based company such as shipbuilding. The OSV market took a hit post 2015, so they suffered very badly. They actually did impairments on almost all of their inventories, and now they're transformed themselves into an infrastructure player. Going forward, they also have been guiding that they want to venture into the FPSO market as well. The pros for coastal is that the current business model is highly certain cash flow, right? Very fixed profits, very stable cash flow, very stable earnings. The cons for coastal is that most of their revenue is sourced from a single client, i.e. Pemex. So currently a majority of their revenue actually comes from just from Mexico alone. So there is a client concentration risk for coastal, but on a profit trend basis, on a predictability basis, it ranks very high because of their infra business model.
Thank you so much, Stephen, for your perspective. The next is by Kiet Xiang. Okay, so the question here is, what is your outlook of Dialog?
Dialog, I've included Dialog as my long-term resiliency play here as well, alongside Yinsen. Dialog, a big portion of Dialog's earnings comes from their midstream oil storage facilities, right? And they have actually long-term contracts with Petronas. It is seen to be actually a very safe business model, recurring income business model. Somewhat very predictable as well. The new catalyst for Dialog is if they can secure a new client for a new phase of development in Pengerang, i.e. further development of phase 3 in Pengerang. So if they can secure a client, that would act as a new catalyst for the stock. But at this current point in time, because of their business model, their huge exposure in the midstream storage space, it is a very good recurring income business.
Thanks so much, Stephen. So the next question is, why do you think Yinsen invested in renewable energy? Is it for good return or just due to ESG?
It's a very good question. You can't deny that ESG it does play a huge role, not just for Yinsen, but throughout the entire sector. But Yinsen, being a well-managed company, right? They do look at project returns when investing into RE as well. So hence why you see their approach to RE is slightly different from some of the local guys. They bid RE projects globally, because they know that in the local market, RE project returns for RE is highly competitive, is slightly lower, so they tend to bid for local for international markets, which can fetch higher returns. So yes, it is for ESG business, but they also place a huge emphasis on project returns as well.
All right, for both lah, huh? So how do you view the high debt level of Yinson?
Sorry, just to elaborate on the previous question. But bear in mind that the current profit contribution at this moment in time from RE for Yinson is still very, very small. So they are still by and large an FPSO company. Right? It's still quite insignificant at the moment. Although in the future, they do have net zero carbon goals by 2030, 2050, those kind of things. So eventually they would want to transition into a more well-rounded energy company, but at this moment in time, they are still very much an FPSO company.
All right. So how do you view the high debt level of Yinson?
The high debt level of Yinson is not as alarming as compared to high debt levels of other companies, like even previously Bumi Armada, although now their debt has gone down, like Sapura Energy. Reason being is most of the debts in Yinson are project finance, right? So it is revenue backed. It is not bad debts. You know, it's revenue backed. Non-recourse. A lot of the projects, when the project starts, a lot of these debts turn into non-recourse, meaning to say that the clients are the one that guarantees the loans instead of Yinson. So if anything fails, the bankers actually go against the clients instead of going against Yinson. As I mentioned, I think the FPSO market is a huge infrastructure. It's a huge capex market, right? To build a new FPSO is a huge infrastructure. So definitely you need to grow your company via debts if you are in the FPSO market. Compared to Bumi Armada in the yesteryears, I know now that the debt has reduced. What differs from Bumi Armada's debt compared to Yinson's debt is that Bumi Armada, their debt arose when they decided to venture into the OSV space many years ago, right? So they took on huge debt, go into the OSV market. But then after 2015, the OSV market crashed. So they're stuck with huge debts, with assets that are worth very little. And they spent the last many years trying to pare down this debt, trying to dispose of their OSVs, trying to impair all their assets. So the debts that are currently sitting in Bumi Armada, and even to a larger extent in Sapura Energy, they are not doing anything. They are very basically inefficient debts, right? They're not doing anything. You just owe people money, but the debt is not generating any returns for you, not generating any profits for you. In comparison to Yinson, because they are project finance debts, these debts are being incurred to invest in projects. So these debts are actually bringing in returns. So these are good debts that they're bringing returns. They're using these debts to actually grow the company. And the debts are cash flow back. They are a lot of the debts after the projects have commenced, they are non-recourse, i.e. they are guaranteed by the clients. So there is very little counterparty risk on Yinson's front.
Yeah, we know that the FPSO is an expensive, project capex, right?
Yeah.
But I also understand that upon completing its lease, the FPSO cannot be redeployed to other assets, right? What's the technical reason for that?
FPSO is actually a very purpose-built infrastructure, right? An FPSO contract is typically very long, 15, 20, 30 years long, right? When I build an FPSO, it typically takes 2 or 3 years. It is purpose-built, so you give me the specs of your oil field, how much production numbers do I need to meet, what sort of specifications that you want. I bring I go to the yard, build the FPSO. It's specifically designed, purpose-built just for you, just for this yard, just for this oil field, just to meet these specifications. So at the end of life, once the oil field is no longer producing, once the FPSO has reached its end of the contract, yeah, basically it goes for scrap now, because that you can't, in order to be deployed somewhere else, you basically have to repurpose the whole asset again.
Okay, I see. Now the LC Titan is still losing for 3 and more quarters. Do you think they will come back in the future?
Yeah, they are losing 3 or more quarters. And the reason of their loss is because of their product spread, right? Their input cost is essentially crude oil, right? Their output price is basically the petrochemical prices. So you can argue that, over the last few years, oil prices has been going up, but the problem is oil prices going up, petrochemical prices also going up, but the petrochemical prices have not gone up as high, as steep as oil prices. Hence why there is a shrinking of their product spread, to an extent that it becomes negative and becomes loss-making. So when will they turn positive? It is when, number one, either your product prices has to go up tremendously, or your input costs, i.e. your crude oil has to come down. Most of the time, these two products tend to trade in a very high correlated fashion. But given the current market, right, it seems that both oil prices and product prices are expected to stay muted.
All right, thanks, Stephen. So let's do one last question before we conclude the session. Is what do you think about the private placement impact on USMA price? So that question is by James.
The private placement, to be honest, we don't think have that much of an impact. What the private placement was trying to achieve was trying to secure finances to venture into the RE space. I think USMA is also one of the companies that are trying to do solar. They have won actually an LSS4 project, and they're actually bidding for a lot of EPCC solar projects as well. But it's not like a 50% private placement. I think it's relatively small. So I think the impact to our share prices is not that great as well.
All right, thank you so much, Stephen, for doing this segment for us. I guess everyone of us here today have gained a lot of insights into this oil and gas sector. So thank you so much, Stephen.
Thank you very much, Shane.
All right, so we have come to the end of this webinar brought to you by Kentrade in collaboration with Rakuten Trade. So I'd like to thank all of you for tuning in to this webinar until the end of this session. If you want to open an account with Kenanga, you may reach out to the Kenanga dealers, or any reminders can contact their social media pages. Or if you want to open an account with Rakuten Trade, you may also reach out to the Rakuten teams, or reach out to them via social media to get an account opened. So with that, thank you everybody, and wish to see you all in our next webinar. Bye everybody.